Japan's debt bomb is detonating right now. Your next mortgage is going to cost you $250 more every single month, not because of the Fed, not because of Biden or Trump, because of a decision made last month in Tokyo, and 99% of Americans have absolutely no idea it happened. In the next 16 minutes, I'm going to show you how one event in Japan is already affecting 3 things in your life. First, the cost of borrowing money for a house, a car, or a business. Second, your retirement account. Third, inflation on everything you buy. And unlike most financial crises you've heard about, this one has already started. Something unprecedented. Happened on January 20th of this year. Japan's 30-year government bond, one of the most stable assets in the global financial system, crashed in a single trading session by more than it ever had in 27 years of existence. And within hours, the US Secretary of the Treasury was personally on the phone with his Japanese counterpart, not to ask, to beg them to calm the markets. What exactly made Washington panic and why it's already changing your financial future is what we're going to break down right now. Let's start with the scale of the problem. Japan's debt to GDP ratio stands at 236%. That is the highest of any major developed economy on the planet. Twice as high as the United States. Put it in personal terms. Imagine you earn $100,000 a year and you owe $236,700. That's the ratio Japan is carrying right now. Economists start getting nervous when a country's debt exceeds 90% of GDP. Japan blew past that threshold in the 1990s and just kept going. So how did they manage? Through a trick that worked beautifully for 30 years and just stopped working. To understand the trick, you need to understand how Japan got there in the first place. In the late 1980s, Japan was living through one of the greatest financial bubbles in human history. Real estate prices nearly tripled in just a few years. Stock prices doubled. At the absolute peak of the bubble, the land surrounding the Imperial Palace in Tokyo was valued higher than all the real estate in the state of California combined. Then the bubble popped, and Japan ran into something every central bank fears: deflation. Prices started actually falling year after year. Deflation sounds good on the surface. Who doesn't want things to cost less? But deflation creates a vicious trap. When prices are falling, people delay purchases because things will be cheaper tomorrow. When people delay purchases, businesses can't sell. When businesses can't sell, they lay off workers. When workers lose their jobs, they spend even less. It becomes a spiral that can last for years, even decades. Japan was trapped in that spiral for 3 decades. To escape, the Bank of Japan did something unprecedented. They dropped interest rates to 0 and held them there. They printed massive amounts of money. And they introduced something called yield curve control, which meant they literally capped how high bond yields could rise by buying whatever bonds were necessary to enforce that cap. The Bank of Japan didn't just become a buyer of last resort. They became essentially the only buyer. As of late 2024, the Bank of Japan owned 46.3% of all Japanese government bonds. For certain maturities, they owned even more. They basically became the market itself. When you can borrow at 0% interest, even a massive debt load becomes manageable. Japan's interest payments stayed low despite the staggering amount of debt. It was like having an infinite credit card with a 0% APR that never expired, except all 0% offers eventually expire. And Japan's just did. Here's what changed. Inflation finally arrived in Japan, after being absent for nearly 3 decades. The rate has been running around 3%, which doesn't sound like much compared to what Americans experienced recently. But for Japan, it represents a seismic shift. An entire generation of Japanese consumers grew up in a world where prices never rose, where keeping cash under the mattress was a perfectly rational financial strategy, where the rules of economics seem to work differently than everywhere else on Earth. Now, those rules are reverting to normal. And the adjustment is brutal. The Bank of Japan raised interest rates in December 2024 to 0.75%, the highest level since 1995. That might sound laughably low, But for Japan, after 30 years of zero, this is a fundamental regime change. And here is where the January 20th explosion comes in. The immediate trigger was political. Japan's prime minister announced snap elections with a platform promising tax cuts and increased government spending. Bond investors immediately did the math. More spending plus tax cuts equals bigger deficits. Bigger deficits equal more government borrowing. More borrowing equals more bonds flooding the market. More bonds equal lower prices, and lower prices mean higher yields. The bond market rebelled in real time. Japan's 3-year bond yield exploded by 30 basis points in a single trading session, the largest daily move since these bonds were created in 1999. The 4-year yield surged above 4% for the first time ever. Some analysts compared it to the Liz Truss moment in the UK in 2022, when unfunded tax cut proposals triggered a bond market crisis that brought down the government within weeks. And that is when Washington picked up the phone. But here is where this stops being a Japan story and becomes your story. For decades, Japanese institutions, banks, insurance companies, pension funds participated in something called the yen carry trade. Most Americans have never heard of it. But it has been quietly shaping your interest rates and your stock market for years. The mechanics are simple. You borrow money in Japan at near zero interest rates. You convert those yen to dollars. You invest those dollars in US Treasury bonds, yielding 4 or 5%. You pocket the difference as essentially free money. Let me walk through a concrete example. A Japanese pension fund borrows $1 billion worth of yen at 0.1%. They convert it to dollars and buy US Treasury bonds yielding 4.5%. That's a 4.4% spread, meaning they're earning roughly $44 million per year in profit on that position with very little actual risk, as long as exchange rates stay stable. Scale that up across hundreds of institutions. Add the leverage that hedge funds use to amplify their returns, and you get a truly massive flow of money that has been supporting U.S. asset prices for decades. Conservative estimates put the size of the carry trade around $500 billion. More aggressive estimates that account for hedge fund leverage suggest it could be $20 trillion or more. Whatever the exact number, it represents an enormous flow of money that has been keeping American interest rates lower than they would otherwise be, which means cheaper mortgages, cheaper car loans, cheaper borrowing for businesses, and a stronger stock market. Now, do the math with current numbers. Japanese 3-year yields are at 3.48% as of this week. After you account for currency hedging costs and transaction fees, the spread between borrowing in Japan and investing in U.S. Treasuries has shrunk dramatically. The free money is no longer free. And if you're a Japanese pension fund or insurance company, you have to ask yourself why take on currency risk and all the complexity of investing overseas when you can earn nearly the same yield at home in your own currency with zero risk? The answer increasingly is that you wouldn't. Japanese life insurers already trimmed their government bond holdings by 1.35 trillion yen in just the 3 months through March 2025, the third largest reduction on record. When domestic institutions won't buy their own government's bonds because yields are swinging wildly, that's a warning sign. And when that same dynamic extends to their foreign holdings, it means U.S. Treasuries are going to have one less buyer at exactly the moment when America needs more buyers, not fewer. We already saw a preview of what happens when the carry trade unwinds. August 2024, the Bank of Japan hinted at tightening policy. The yen strengthened rapidly, forcing investors to exit their carry trade positions. Bitcoin crashed 23%. The Nasdaq fell 10%. The S&P 500 dropped 8%. It happened fast and it was ugly. And that was just a preview, a partial unwinding over a matter of days. A full unwinding would be significantly more severe. The U.S. government is currently running annual deficits of around $2 trillion. Total national debt stands at $38.6 trillion as of February 2026. Every year, the Treasury Department has to sell bonds to finance that deficit and roll over maturing debt. When a major buyer like Japan steps back or starts selling, it puts upward pressure on yields because the remaining buyers demand higher returns to absorb the extra supply. And it's not just Japan. Europe collectively holds close to 40% of all foreign-owned US Treasuries, around $8 trillion. European governments are now under enormous pressure to dramatically increase defense spending. Where are they going to get that money? One option is selling some of their US Treasury holdings. So you have the two largest foreign holders of US debt potentially becoming sellers. At the same time, when the US government needs to sell more bonds than ever. Higher Treasury yields flow directly into your life in ways you might not immediately realize. Mortgage rates closely track the 1-0-year Treasury yield. As of this week, the average 3-0-year fixed mortgage rate sits at 6.11%. The 1-0-year Treasury yield has been climbing, reaching 4.24%. And the recent volatility in Treasury markets suggests more upward pressure is coming. Remember that number from the opening. Every 1% increase in mortgage rates on a $400,000 home adds roughly $250 per month to your payment. Over a 3-0-year mortgage, that's over $90,000 in additional interest. The assumption that rates will fall back to pandemic-era lows is almost certainly wrong. Stock valuations are also sensitive to rising rates because of how investors calculate the present value of future earnings. When rates rise, future earnings become worth less in today's dollars, which means stock prices should fall even if the underlying companies are doing just as well. There is something else many investors don't appreciate. The traditional relationship between stocks and bonds may not protect you the way it used to. Normally, when stocks fall, bonds rise as investors flee to safety. But when the concern is government creditworthiness and rising rates, both stocks and bonds can fall together. Ken Griffin of Citadel has explicitly warned about exactly this. Bonds lose what makes them special in a portfolio when they start moving in the same direction as stocks. The situation gets more complex. The Japan situation is complex, and it's tempting to tune out because it seems so far away and so technical. But the global financial system is deeply interconnected. The flows of money between Tokyo and New York have been shaping American interest rates for decades. Those flows are changing now, and the change is structural, not temporary. The good news is that this isn't a sudden crisis requiring immediate action. It's a slow-moving shift that will play out over years. That gives you time to adjust, to reposition, to prepare. But preparation requires awareness. And most Americans have absolutely no idea that events in Japan are about to reshape their financial lives. The era of cheap American borrowing, subsidized by foreign investors willing to accept low yields, is coming to an end. That reality is going to show up in your mortgage statement, your investment returns, and the price of everything you buy. Now you know what's coming. What you do with that knowledge is up to you.